Yeah, welcome to everybody. Great to have you here. And yeah, we did one of these about a month ago with our partners at Currency Hub. And yeah, please do stop me at any point if you have any questions. You're welcome to unmute yourself or post in the chat. It's good to get your perspective and see what is on your mind. And yeah, I'll also leave some time at the end for more questions. I'll try and keep it pretty short and sharp. Um, And yeah, always what a time in markets. We've had north of $100 billion of inflows into IBIT, BlackRock's ETF. Also, if you could, I assume you can hear me. I assume you can see me. If you have any problems with that, obviously let me know. Um, yeah, north of $100 billion of AUM in IBIT's in BlackRock's IBIT ETF clearly shows that there's an institutionalization of this asset class. Um, but yeah, the reality is that we are seeing our macro indicator turning. We chatted about that briefly in the last call, and we'll go into more detail on that as well as a few more kind of market related signals. The feedback from the last call is that a lot of people wanted to see more market related signals. So important to note, this call is obviously not an intro to Bitcoin. It's also not kind of the broader context of like the value and valuation of the asset class. We'll have a poll at the end if you're looking for that type of thing. Obviously, let us know, answer the poll, and obviously, you can also send me an email or post a comment in the chat. But yeah, we'll chat about the short-term liquidation event that we saw last month. What's going on with long-term holders, short-term holders, ETF, digital asset treasury companies. And to start with, I wanted to just provide a little bit of allocation context because, from my perspective, these trading signals are obviously very interesting. And looking at the markets is great. Super to analyze, but looking at market signals without the allocation context can be a little challenging. So, we need to have thought about what is the portfolio construction decision. So, as a starting point, of course, none of this is investment advice. Do your own research. But the way I often speak to clients, friends, family about the asset class is that the allocation percentage is more important than price. Because obviously, this presentation is going to be focused a fair amount on price, but the context here is that allocation percentage is more important. If you look at the historical impact of small allocations to Bitcoin in a balanced portfolio, so 60-40 balanced portfolio, equity bonds, 1% allocation to Bitcoin and 2%, 5%, 10%, you see dramatic positive impact on a portfolio. And you could say, okay, well, listen, this is far too long a time horizon. Bitcoin had incredible returns in the early stages. Well, even if you take that to since 2020, you're still seeing really strong impact on a portfolio perspective. 2% to Bitcoin uh, resulted in 8% annualized alpha above a 60-40 bond portfolio, 10% allocation resulting in 13% annualized alpha. And yes, of course, there's volatility and drawdowns, but in a portfolio context, um, this is the drawdown of a 60-40 portfolio. So the drawdown from the peak. So, at around 8% there and around 20% here in 2022. Okay, what impact does it have when you add in that 5% in the Bitcoin? You can see that these drawdowns in a portfolio context are actually not that much bigger. Even if you go all the way up to 10%, sure, the drawdown is bigger here in 2022 from 20% to 25%. So that's all a kind of a preamble, but I think it's just really important to think for yourself, what is the portfolio context, right? Because for instance, if you've made a small allocation into the market at say 1%, you know that's unlikely that you're going to be trading around that position. Maybe it's possible, but more likely that you might have been thinking to yourself, okay, how do I grow that allocation over time? And that's obviously very different from somebody who has 50% of their net worth in the market. They're hugely invested, and they were planning on, trimming exposure at some point in the cycle. These type of market indicators would be of greater value and potentially trigger decision making on the back of them. So I'm going to start with the short term actually, and kind of build out to the slightly longer term. So over the last month, we did see a liquidation event, and the short term that could support price. So the context here on the liquidation event, that was on the 10th of October last month. Um, yeah, when it was initially triggered by Donald Trump tweeting about tariffs on China, but that kind of it triggered a liquidation cascade in a number of crypto exchanges. There were a few kind of idiosyncrasies in the crypto markets there of pricing on a stable coin on Binance. Um, I would say I would call those all kind of trigger events, because the reality is, of course, there was a fair amount of leverage in the crypto markets, and that leverage did kind of pull off significantly. So this is open interest on Bitcoin and ETH. We've seen quite a sharp decline. If you look at the rest of if you were to include other crypto assets, though, the reduction in leverage would be more significant. I mean, some of these coins dropped precipitously in one day. Some of them going, all the way down to zero. The prices did recover, but it was a really big, noteworthy event. Now, historically, these type of events actually can be very positive for price in the short term. So I'm just going to draw your attention to that. The liquidation dominance is looking at liquidations, right? When leveraged speculators uh, they get a margin call, they don't meet that margin call. That means they're liquidated out of their position, and you can get a reading on whether those leveraged speculators, the liquidations were on the long side or the short side. So our liquidation dominance is looking at the relationship between those long and short liquidations. And when it's rising like this, it's telling us that a lot of longs have been liquidated relative to shorts. That's really the conclusion. Um, and that makes a lot of sense. Price declined. You would see those on the long side. Those are the ones that are being liquidated. And historically, this has actually had pretty strong relationship to subsequent returns from Bitcoin. So that's on the right hand side here. Bitcoin returns. Now, of course, it's not perfect. No indicator is perfect. All indicators fail at some point. So I'm not saying that this is predictive of exactly what's going to happen over the next month. It's just a potential scenario that is under consideration when you have these large liquidation events. And this little section is touching on similar type of information. So another way to view these leverage speculators is the cost of funding for those positions, right? So if you're going leverage long, you pay some sort of cost of funding in perpetual Bitcoin futures or crypto futures. We measure that in the funding rate. And if that's very high, that means that speculators are willing to pay a high interest rate in order to be leverage long. That tells you things are more frothy, and that can be a signal of concern for future price direction. Whereas the opposite is true. When funding rates are very low, that can suggest a fair amount of pessimism. And that's where we are at the moment. Funding rates are low, and there is a fair amount of pessimism. That, once again, in the short term, that can be a positive signal for price. And then similarly, here we're looking at the short-term cost basis. So, I will try and provide a little bit of context on all of these indicators. If I'm losing you at any stage, you're welcome to, post a comment, and I can slow it down even further and describe to you what each indicator means. Short-term cost basis is so first of all, what is a short-term holder versus a long-term holder? So in Bitcoin, we obviously have the blockchain. That is that provides a huge amount of data about transactions and wallets that are transacting on the Bitcoin network. And what we do is classify wallets into what we'd call short-term holders versus long-term holders. The distinguishing feature being that long-term holders have held those assets for a longer period of time. That tends to suggest that they're more illiquid, and they tend to be they tend to be more likely to continue holding, whereas short-term holders are less likely to continue holding. So we see the short-term holders as a slightly more speculative aspect to the market. And what I'm showing you here is the short-term holder cost basis. So the cost basis is just the price at which the price at which those short-term holders bought their assets. And here we're now looking at the change in that. So what is this telling us? It's telling us that short-term holders are selling at a loss, right? So they're capitulating on their positioning at a lower price. So that capitulation similarly can also be a sign of an overextended market to the downside. And you see that historically here, these liquidation of these reductions in the short-term holder cost basis here in the blue. That's over here, over here, over here. These can be bottoms in price, right? So I mean, this little section here on kind of more on the futures market, on leverage, tells us that there has been quite a washout, and that there is a bit of a capitulation event, and that can be positive for price over the short term. So I think that's an interesting consideration. All right. So, and then, that being said, this short-term holder cost basis is something that we do monitor quite closely because, momentum is important in most markets, but particularly in crypto markets, in Bitcoin. And a loss of upside momentum is a noteworthy event, and we clearly have seen a loss of upside momentum, over the last month. And we do use this Bitcoin price relative to that short-term holder cost basis as an indicator of momentum. And so, what we really need to see a kind of continuation of upside momentum in price is for price to recover back above that short-term holder cost basis. Now, historically, through this cycle, there have been periods of time where price has dipped below the short-term holder cost basis. So price obviously here is in orange, short-term cost basis is in dark blue. But yeah, it's quite important that we do see a recovery, because if you look at previous periods of time of extended price weakness, it tends to be that this short-term holder cost basis starts to act as resistance. So that's something that we've got an eye on at the moment. And so far, we have seen a little bit of that. Price did come up and meet the short-term hold cost basis as resistance. So that is something to keep an eye on. I just see a question here from Ben. Yeah, you're very welcome to post a question at any time. You're welcome to unmute and shoot through a question, or just write in the chat. I see a question here. Yeah, so I mean, Bruno's just asking about like the reliability of these on-chain signals. Listen, they're never perfect, but I do think they provide us quite a good, reasonable approximation. And you can actually see that in the data, like the fact that this, in the chart that I'm showing you here, that price kind of came back and used the short-term holder cost basis as resistance, when what led up to a more kind of bear market price action, I think is quite insightful. Yeah, so these things are never perfectly accurate, but they are they're insightful, and you can say the same thing about all economic and financial models. So we've touched on the short-term holders. Let's look at the long-term holders for a moment here. So the long-term holders are, as I said, opposed to short-term holders. They tend to hold for a longer period of time. we it's healthy in the market for a significant portion of Bitcoin supply to be held by these long-term holders because they tend to be um, illiquid long-term holders, right? And so we have seen a reduction in supply over the last 2 years. Now, this is actually not the precise definition of long-term holders. I've adjusted it slightly to look at it over 2 years, um, because the actual movement in long-term holders has not been significant. The reason for that is that most of the supply has been taken up by ETFs. So ETFs have been buying a huge amount of Bitcoin. This is, as I said, the AUM in US based ETFs in over $140 billion. Yeah, so we've seen this reduction from kind of the OGs, you know, long-term Bitcoiners have been, reducing and distributing their supply, and a significant portion of that has been taken up by Bitcoin ETFs. As I said, that kind of confirms that this kind of institutionalization of the asset class, which is a key theme. But the concern here in the short term, this is just looking at kind of the 30-day change in flows, is that the flows have moderated in recent months. Now, of course, that could change, but for now, the ETFs are not really soaking up all of the demand that has been brought onto the market by these long-term holders selling down on exposure. And I mean, net, that is exactly why we are seeing a weakening in price in the short term. The other kind of component to bear in mind here is digital asset treasury companies. Now, I won't go into all the details of what these are. We touched on a little bit in the last call. If you'd like more information, obviously let me know. But the digital asset treasury companies are essentially listed equities that are buying underlying crypto assets, and they were a big driver of the market through 2024, 2025. This is looking at the purchases of crypto assets by digital asset treasury companies, or DATs, and significant through 2024, through 2025. But this is clearly tapering off and tailing off. And I mean, here it's almost slightly easier to get predictive, is that, without a sudden increase in price, it's very difficult to see these digital asset treasury companies buying more because they need upside price momentum and positive sentiment to get further funding to buy more crypto assets. So yeah, this is tapering off, and that so the conclusion being here that these two major drivers of the cycle thus far have softened. And the other point I wanted to make here, I just skipped over it quickly, is that Bitcoin does still have a strong correlation to the S&P 500. That's what I'm showing you here in this orange line, the correlation between Bitcoin and the S&P 500. It has, dipped a little bit in recent months, which was encouraging, but in reality, it's still quite elevated. And I would expect these ETF buyers to be kind of more susceptible to swings in global risk appetite than your kind of OG Bitcoiners, who might be a little bit more kind of idiosyncratic and isolated to the Bitcoin market. So any kind of sneeze in kind of global markets would be would probably be a challenge given this elevated correlation. Yeah, let me just touch on the chat here for a second. Yeah, I mean, on this question about ETFs and who are the informed holders, ETFs versus long-term holders. Well, listen, I think the initial bias would be, yes, that the long-term holders would be the most informed. They're the ones that have been in the market for a significant portion of time. So the jury's still up on exactly how how the ETFs behave and how they hold or sell down on their exposure. One thing we have seen is that a lot of them have moved into that long-term holder bucket. So Sure, they might not have been holding as long as the OGs because the ETFs have only been around since January 2024. Um, but yeah, they haven't been acting like short-term holders. For instance, as a contrast, they haven't just been trading and selling down on the exposure. But of course, we cannot rule out that possibility. Okay, and I'm going to get to the question about the debasement trade a little bit later. All right, so on the macroeconomic component, I mean, for me is probably the most important. I mean, a key is the key component to our investment process is our macroeconomic indicator, which is shown here in the black line. What is this? This is just basically showing us the uh, basically the health of the dollar system, or a way to articulate the health of the dollar system. Because for me, Bitcoin is a non-state money. It is a response to the traditional financial system. The dollar is obviously at the center of the global financial, monetary, and currency system, and so that's why we use this. More health in the dollar system implies less need or appetite for alternative monies. And so, what we've seen historically is a strong relationship between our macro indicator and Bitcoin. At the moment, we have seen some weakness in this macroeconomic indicator. So, what are the drivers there? Just briefly, I mean, the dollar. So this is the euro versus the dollar. Through most of 2025, we saw a fair amount of euro strength, dollar weakness. Dollar weakness, it kind of feeds into that debasement trade that was referred to in the chat there, um, which we'll touch on a little bit more later. But yeah, that does provide a tailwind for asset markets in general, particular for slightly more kind of commodity centric assets like gold and Bitcoin. Um, at the same time, we also have seen the yield curve has not been steepening as much as it has been historically. Steeper yield curve is good for risk appetite, good for Bitcoin. It hasn't really been crashing, but it has just been moderating, flattening ever so slightly, and money supply growth also. That had been rising quite firmly through 2023, 2024, early parts of 2025, but it's moderated in recent months. So less new money filtering into the financial system and through to the economy, into financial markets. And this all kind of gives rise to our macroeconomic indicator pulling back. Now, listen, historically, this has had actually quite a strong lead relative to Bitcoin. So I'm showing you here, with Bitcoin, this is in log returns, so it's just kind of dampened the volatility slightly. And you see historically, there's quite a big lead. If you go all the way back to 2017, macro indicator peaked and Bitcoin peaked, way later. Same thing in 2021, and the macro indicator peaking kind of early in 2021 and Bitcoin peaking late in 2021. So, this doesn't necessarily provide like a short-term prediction on price. It's very possible that price can still rise higher in the short term while the macroeconomic indicators is falling. But the context here is that those kind of winds are changing, and they can obviously turn, and we'll get onto the potential ways that it can turn in a moment, because I think it's very possible that it does. But for now, it is declining, and in this context, I would say that the probability of returning to new all-time highs is significantly reduced. You can never rule that out, but yeah, these are more challenging macroeconomic conditions, and that is absolutely critical towards price performance in this asset class. So yeah, touching on price, like specifically, and levels, and how we think through these things. So because we've touched on some components of our investment process, and for us, looking at price itself is also an important technical component. So we did see like a reversal on price, above 120,000, that is also a point of concern, and it does suggest a reasonable probability of returning to this $100,000 level, potentially to a $90,000 level. Those tend to be kind of our base case under these conditions. Obviously, there are lots of different scenarios that could play out here. There's a significant amount of support for Bitcoin in this kind of region between 100,000 and 110,000. I don't think I have the chart in this presentation, but a lot of Bitcoin have traded around this level, which is a significant area of support. So one potential scenario is we, dip briefly below 100,000, and maybe the market recovers from there. Maybe macroeconomic conditions have changed by then, and things start to look more optimistic. Another scenario is we dip more deeply back to kind of 85, $90,000. If macroeconomic conditions have not changed, I think that becomes a higher possibility. And for us, we think that it's very unlikely that price falls for any length of time below $70,000. So $70,000 is very close to the previous all-time high. We saw a significant amount of Bitcoin volume trade around that level. That would also mark a 50% retracement from the highs. And as I said, this Bitcoin is an institutional asset class now. So I think that the idea of kind of a protracted bear market for a full year is a lower possibility event. But yeah, from our perspective, we'll be very much kind of monitoring our macroeconomic indicator and assessing how that transpires. Of course, if it continues to decline precipitously, that would be reason for concern. You'd probably see much more impact on risk assets in general, on equity markets, if that were to take place, and of course, crypto would not be spared under those conditions. But yeah, as I said, for us, we see kind of a less than 5% probability of spending much time below 70,000. I would put the probability of returning to new all-time highs probably also less than 10% at this level under these conditions. It's very possible though that we also do see short-term strength, as I've noted earlier in the presentation, given the leverage unwind. Very possible that we do see a recovery back up to 110,000, 115,000. Those are very likely scenarios. But yeah, if I'm looking kind of 6 months out, our base case is more tilted towards a test of 100,000, a test of 85,000, and some other components to get to on the markets. But I just wanted to reiterate the portfolio context that I said at the start. One really needs to think about how one has constructed one's portfolio and how one wants to manage this type of information, because I just don't think that it's it's certainly not prudent for all people to suddenly try start trading their assets, because I've experienced in that myself, but I'm also experienced in speaking to many friends and family and colleagues, and I'm aware of the damage that people can do to their portfolio construction thesis, by suddenly thinking they become traders on the market. And yeah, I think important. I mean, we've spoken through these scenarios. One thing I do think that is probably worth pointing out is that downside volatility in other crypto assets tends always to be higher than relative to Bitcoin. So kind of an ETH BTC, we saw a nice rally through the second half of second quarter of 2025, so third quarter of 2025. But basically, that only retraced like 50% of this decline since May 2024, and now we're pulling back from that level. That's not a particularly great sign. I mean, ETH is holding up much better than the rest of the market. which is also no surprise that it is kind of a blue chip asset relative to the rest of the market. But I think also what's not a good sign is that the darling of the cycle, hyperliquid, that's a decentralized exchange. I mean, you don't necessarily need to know too much about the asset. All you need to know is that it's very much the darling of the cycle, and it also seems to have, shown a reversal, even relative to Bitcoin, but also on a dollar basis. That just suggests that there's a fair amount of heat coming out of the market. As I said, there's lots of different scenarios of how this might kind of transpire going forward. But yeah, at the moment, we do think that the upside to new all-time highs is probably capped, not necessarily capped in terms of short-term upside over the next month. But yeah, for conditions to really improve remarkably, we would need to see a significant improvement in our macroeconomic indicator. So a couple of questions here on the debasement trade. So the debasement trade, what does that mean? That mean that debasement of dollars, right? So we've got we're in a dollar system. I mean, I've actually got a few more charts here too. I'll put up the question here too. The debasement trade is very much kind of speaking to this. I mean, this is deficits or debt levels would be another way to look at it. Global governments are in a huge amount of debt. They have got no appetite to reduce that debt. They've got no appetite to even reduce their deficit. We've got a further confirmation of that this year through Elon Musk's failure at Doge, Department of Government Efficiency. And that implies that governments, the only way for them to try and manage these debt loads is to weaken the currency, to debase their currency. And the debasement trade is investing into assets which can benefit from a weaker dollar, from debasement of fiat currencies. And gold and Bitcoin isn't gold, Bitcoin, property, any asset, S&P 500, NASDAQ, they all have the potential to be a hedge against debasement, right? But they obviously all have different vectors of what they are good at and not as good at, right? So obviously equity markets are more kind of growth sensitive there. So if you go into like a truly stagflationary environment of very weak growth and high inflation, well, some equities will do well in those conditions, but not all, right? So equities don't necessarily benefit very well in that environment. Gold and Bitcoin are very similar in terms of them both being non-yielding, essentially non-productive assets. They're much more clear monetary assets. So in that sense, that I would argue that they are purer debasement assets. And so Bruno is asking here specifically about why has Bitcoin not done as well this year relative to gold? Well, I mean, just looking at it 1 year is probably not a true reflection, right? You obviously have to look at these things in historical context. Bitcoin is up significantly relative to gold over many years, and you could make the argument that kind of gold is playing catch up over the last year, and yeah, there's I think that's a very fair way to look at it. But yeah, over the long arc of time, Bitcoin has outperformed gold significantly, and I would expect that to continue going forward. I mean, I'm very constructive on gold. I hold gold, but yeah, I do think that and gold certainly has its place. There are benefits from one over the other. And if you like me to go into the details of that, you obviously let me know. But I do think that Bitcoin has a lot of benefits over gold, which are quite powerful, like the ability to store it, the ability to move it much quicker, much more effectively, much easier. Um, all right. So another question from Bruno about the Genius Act, its impact on stablecoins. Is the health of the dollar and the health of the Bitcoin system one and the same? So yeah, touching on stablecoins. Stablecoins, for anybody who doesn't know, those are dollars on a digital rail. There are obviously different ways to construct these things, but most of them are fully reserve backed. So holding short-term treasuries as a um, holding short-term treasuries, on reserve, and then issuing the digital component. The Genius Act was passed in the US this year, which regulates stablecoins. Incredibly powerful regulation. It basically regulates stablecoins as though they're money market funds, which brings a lot of confidence to the market. And so you know Bruno's asking here about whether how important stablecoins are to the crypto ecosystem. Well, I mean, listen, I think they are important. In terms of the health of the ecosystem being one and the same, um, yeah, listen, still think Bitcoin is it is in the short term, of course, it would be affected by anything in the stablecoin ecosystem. The markets are interlinked, but at the same time, I still think it is a robust, independent monetary system that can exist without stablecoins. And sure, if you had I mean, not that I'm in any way forecasting a blow up in stablecoins, but if you were to, sure, that would have an impact on Bitcoin price, but I wouldn't expect that to actually like structurally undermine the Bitcoin ecosystem. Um, so yeah, these markets, I mean, financial markets are forever intertwined, and as Bitcoin becomes institutionalized, which is what has happened over recent years, with ETFs, with stablecoins, with regulation of stablecoins, the markets become more intertwined. Correlations can go up, um, volatility tends to go down, which is what we've seen. So that's kind of unavoidable. It doesn't. There are, of course, some downsides to that, right? The correlation relative to equity markets. Not everybody likes that. We like to think about Bitcoin as this differentiated asset, and I still think it is a differentiated asset, but high correlations can persist for a period of time, and that's just an implication of an increasingly institutionalized asset class. All right, we've got time for one more question. Any other questions? So Bruno's asking whether the integration and institutionalization of Bitcoin is not the antithesis to Satoshi's original vision. You definitely could make that argument, but I guess my argument is that the institutionalization of the asset class is inevitable and is unavoidable. So we can talk about the negative consequences. Of course, we can do that. We can talk about the impact of high correlation. We can talk about the impact of high surveillance. Uh, Stablecoins, very much will be surveilled. Um, Bitcoin is reasonably easy to surveil, so we can talk about all these negative consequences, but we can't change the inevitable. Like, Bitcoin is an incredibly powerful asset. We expect that it will become a reserve currency of the future. In fact, it already is a reserve currency. We expect it will become more prominent over time. Well, how is it going to get there? It's going to get there through adoption. And where are the big pools of capital to adopt it? They're in traditional financial markets. And so the getting more financial products on top of crypto assets is happening, and we should expect more of it. Um, and I mean, the next big step in crypto markets will be to bring more traditional financial markets onto crypto rails. So we should expect to see equities on crypto rails. We should expect to see bond markets, corporate bond markets on traditional rails. Tokenization of all these assets, um, bringing more traditional capital into crypto markets. And once again, there'll be consequences to that. But for me, it's inevitable, and all we can do is kind of manage the consequences, try and continue to make sure that Bitcoin is decentralized, that there are ways to maintain one's privacy, and that is the case. Fantastic. Well, if there are no more questions, we'll call it there. I appreciate all the questions that did come through. If you've got any more, obviously let me know. If you've got any feedback, let me know. We did